Option trading is a way for investors to gain exposure to the price of an underlying asset. An option is a financial instrument that gives an investor the right but not the obligation to purchase an asset at a certain price. An option does not physically exist. The act of trading an option is called option trading. Example of option trading. For example, suppose a company produces an okay feathery product. The company sells the options on its product. A buyer pays a fee to the seller for the right to purchase the product at a predetermined price. If the price of the product goes up after the buyer purchases the option, then the buyer loses money. However, if the price of the product goes down, then the buyer makes money. Why option trading? One of the main reasons for option trading is that many investment opportunities are difficult to find. It will give an investor an opportunity to take advantage of price moves without being involved in the day-to-day running of the business. Also, in some cases, it may be cheaper to buy and sell options than it would be to buy the asset outright. Option trading basics. An option has a value based on how much it can move. For example, if a stock is $100 and an option on the stock is $10, then the value of the option is 10 times greater than the value of the stock itself. Options are also affected by market conditions. Option trading strategies. Option trading is a strategy that takes advantage of the price movement of an underlying asset. One of the ways an option trader can make a profit is to short a stock. Shorting a stock means that you are betting that the price of the stock is going to drop. One way to make money shorting a stock is to buy an option. A buyer of an option has the right to sell the stock at a specified price. If the price of the stock goes below the option's price, then the buyer has the right to sell the stock at the price specified in the option contract. However, the buyer is only obligated to sell the stock at this price. Option trading risks. Option trading is speculative and carries a level of risk. Some option traders use sophisticated computers to forecast the price of stocks and options, and buy and sell options to take advantage of the price moves. However, even with the use of sophisticated technology, option traders can make mistakes. For example, suppose a trader believes that the price of a stock is going to rise. The trader buys the option to purchase the stock at $100. However, the trader does not realize that the price of the stock is already at $100. The trader then sells the option to a third party for $10. The third party then purchases the option to purchase the stock for $100. The trader loses $10. However, the third party has made a profit of $100. Also, if the price of the underlying asset rises, then the option writer. This means that the person who sold the option contracts the right to trade the option to third parties at a set price. If the option writer decides to sell the option to third parties for more than he originally paid for them, then the option trader will have made a profit. However, if the option writer decides to sell the option to third parties for less than he originally paid for them, then the option trader will have lost money. Option trading and risk. Option trading can be risky. However, there are a number of ways option traders can reduce their risk. One way is to research the underlying assets. For example, Suppose a trader believes that the price of the stock will rise. The trader can get a detailed report of the company. The trader can also research the company's competitors. The trader can then determine whether it is correct to assume that the company's growth will continue. If the trader believes he is correct to assume that the company's growth will continue, the trader can then determine whether to buy options on the company's stock.